Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy.
Jonathan, thank you so much for joining the podcast today. Sort of to my first question, I recently saw a stat, and I think it's a stat that you've actually shared, that investors have never been more bullish on US equities. Yet you believe there's sort of quite a lot of risk in the markets. Can you explain this hypothesis a bit more?
Yeah, well, thanks very much, Anthony. Yeah, I mean that is certainly true. There's no shortage of measures of sentiment and quantifiable measures as well that indicate that investors in the U.S. markets and to a lesser extent other major markets are historically bullish. And one of the measures would be margin debt, which is at an all-time high in the United States, certainly. And even perhaps more disturbing to me is that the rate of growth in margin debt is approaching levels in the last 12 months that we saw just preceding the bursting of the internet bubble at the turn of the century and previous to the 2008 financial crisis. In my own experience as a money manager, I found that one of the most reliable strategies to generate good long-term returns is to take advantages of extremes of a sentiment, whether people are extremely bullish or extremely bearish, and trade opposite against that sentiment. Now, that's difficult to do psychologically. And that leads into another avenue where our own human psychology, in my opinion, is our biggest obstacle to successful investing. But certainly we're at a stage now where investor sentiment, certainly in the United States, is at historic levels in terms of being positive.
Yeah, definitely. So you mentioned margin debt there and so the rate of growth. What is margin debt? Can you explain that?
Well, yeah. Margin debt is basically if you have an account where you hold securities, a brokerage account, you can borrow against those securities. The brokerage firm or whoever you're dealing with will advance you the money using your existing securities as collateral. Leverage is fine when it's working for you. But it can be really painful and problematic if the trade is going against you. And certainly if, let's say you're on 100% margin, this is theoretical, where you basically borrowed 100% of the value of your existing securities. Well, a 25% decline in the value of the underlying securities you hold would translate into you losing 50% of your money, because you'd also be losing on the shares that you borrowed to purchase. So it can be quite a painful lesson for investors, and it can also have substantial effects on the market, because when you're in a market where there's a lot of leverage, whether it's margin debt or any other type of leverage, once we start seeing a concerted decline in the markets, the presence of that margin debt can serve to accelerate the decline, because people are getting what they call margin calls, which is if you don't have enough collateral in your brokerage account to cover your loans, you either have to sell the securities yourself, or the brokerage firm will sell them for you. And so the level of the presence of margin debt is so high now that it creates a level of risk overhanging the market that is unusually high, compared to historic norms.
I find that quite interesting, because we saw obviously a big hedge fund recently, I can't remember the name, they had a margin call and that caused massive losses, I think, for some of the big banks as well, like Credit Suisse. I think they lost 5 billion.
That's right.
Yeah,
that's right.
I guess the issue would be if there's a 20% market correction potentially, and then there's a bunch of these margin calls that these companies can't pay for, that's when we might see sort of dominoes effect.
Well, that's exactly right. And actually, based on my own work, is the the hedge fund industry right now as a whole is highly levered because they're taking advantage of a rising market. So there's a good deal of debt that's exposed to equity markets, throughout the global financial system, and it's a concern to me. Now, I might add also that one of the things I've written about in the Global Investment Letter this year, which I think is an important point for investors, is that I said that I've never made so much money on the long side while I've been so bearish. And I think the key point here is that it's very important for investors to have a larger view of the risk reward of the markets. But at the same time, on your individual positions, unless you get a clear sell signal, and I have my own that I've generated over the years of my career, and I suppose everyone has their own indications. But I think an important point is that even though you may be bearish about the overall markets, if you have some long positions that are doing well, don't sell them until there's a clear indication that there is that there's a good deal of risk in holding them further. Because even though I have this bearish view of markets, which I think ultimately is going to be proven correct, it's impossible to time markets with any real precision, because markets are basically a reflection of human psychology. And we all know that human psychology is an unpredictable and fickle thing. So that's a point I'd like to put across to your listeners, Anthony, is that on the one hand, it's very important to have a view of markets in a broad sense, so that so that you do have a sense of risk reward. But at the same time, too, wait until you have a concrete reason to sell your positions, because they might go up another 10 or 20%. Now, one of the things I also do in the Global Investment Letter, to me, it's a bit, the Global Investment Letter is a bit like my trading diary, is that it's my own thoughts on the markets and my own positions of my own account. And I share that with the readers, the subscribers. And so what I've also been doing has been adjusting my sell targets as the market's been going up to lock in and preserve the gains that I have accrued on the long side, with the expectation that ultimately we're going to see a market correction and or a bear market. And I think that's a good practice for any investor in the stock market to do, is to always, at the same time, while you want to let yourself have the exposure to make money, at the same time, too, you should always be cognizant of risk. And, there's nothing worse than, making a good return on a stock or whatever investment and just holding it until you lose all your gains. So that's just sort of, I suppose, a bit of an aside, but I think it's an important point, and it's one that I've thought is particularly important to communicate this year, because we're in exactly the kind of market environment where that approach is most appropriate.
Yeah, definitely. And you sort of mentioned there that you're looking for a few indicators potentially. And I know one thing that I've seen you mention is a surge in economic growth, and you think it might be temporary, especially for sort of company earnings. Are there any other things that you're watching out for that could potentially that you're looking for that it might be time to sell potentially?
Yeah, well, I've developed over the years, my style has evolved from being originally a pure value investor when I first got into the investment business, and it's evolved over the years for me being now essentially a global macro investor that basically has developed a pragmatic approach that uses fundamental analysis, technical analysis. I look at the economy. I also look at geopolitics and historic precedent, and that's based on the premise that I think that all markets and many things in life are connected. and that the broader the view that you can cultivate, the more context that you could provide for yourself as an investor, the better your results are going to be over time. So in terms of my own looking at sell signals and so on, sentiment plays a large role. So when I start seeing extremes like we're seeing now on the bullish side, that gets me thinking, be especially watchful for indications of a change of trend and so on. And then beyond that, I do look at historical and fundamental factors. Right now, I do think that the discussion around whether the burst of inflation that we're seeing is going to be sort of a secular phenomenon or not is a hot topic in investing. And right now, I'm still of the view that it's a temporary phenomenon that's a product of the recovery and the stimulus from the global pandemic. And now I could turn out to be wrong about this, but right now the evidence suggests that that is the case. And I do try and respond to changes in evidence in the facts. So I hope I'm smart enough that if the weight of evidence starts suggesting that inflation is going to be a secular phenomenon here, I'll be smart enough to sort of adjust accordingly. But I do recall after the 2008 financial crisis, and we saw the stimulus to combat that then, that I was of the view at that point that it was going to prove to be inflationary. Well, that didn't turn out to be the case. We did see, like we're seeing now, a temporary move in inflation upwards, and we also saw a bit of a lift in the commodity markets. And we've seen that lift in commodity markets this time as well, although we're also starting to see now some commodities like lumber and so on starting to sort of come off. So right now, 2021 looks like a bit of a replay of what we saw in 2008 to 2010. But I do stand to be corrected there. But that is a factor. That is a factor. And if I'm right about that, you're going to see the corporate earnings growth start to slow considerably in the second half of 2021 and into 2022. And one of the little analogies that I write about in the Global Investment Letter is that investor expectations and economic reality are like trains on parallel tracks, just sort of running side by side of each other. And at some point, those tracks are going to cross. And when those tracks cross, that's going to produce a good deal of market volatility because that's likely to produce either a fairly significant correction or a bear market. When that happens, I'm certainly not smart enough to know, but what I'm smart enough to know is that there are things that investors can do to prepare for it. And we talked about that a little bit, earlier in terms of being aware of the situation, setting some sell targets so that you don't, if there is a meaningful pullback, you at least preserve a good chunk of your accrued profits and so on. And I think the other thing as well for investors is seek out information. Whether you're investing for yourself or you're having somebody invest for you, a financial advisor and so on, it's always a good idea to have a working knowledge of the market so that you can ask good questions. If you do have an advisor or you're doing it yourself, many times the questions are more important than the answers, so to speak. And so I encourage people to do that, read widely. One of the great things about the internet is that, there's great access to information. And there's, there's also resources like the Global Investment Letter, that provides I provide an independent perspective and so on. And you can, my goal here is not necessarily to have people agree with me or do exactly what I'm doing, but just to provide some food for thought and analysis. And for example, we talked about inflation. Well, in the last issue, I did a very deep analysis of sort of where I saw inflation going in the current situation, which is kind of beyond the scope of our talk here. But it's these are worthwhile perspectives to to cultivate. And of course, from my standpoint, I got into the investment business just because it was very interesting. It wasn't because I wasn't necessarily wanted to make $1 zillion or anything, but it's just a fascinating pursuit, whether you're doing it professionally or sort of for your own purposes. You're really being paid to sort of study the world and what's going on in the world and so on, and to me, that's perhaps as big or a bigger compensation for being interested in investing than whatever amount of money you can make.
Yeah, definitely. And as you said, I guess if the listeners are listening to this podcast and hopefully others, and they're obviously wanting to learn more about economics and, reading your newsletter as well, they just want to learn more about the current financial scope, which is, I think, a great way to look at it. So one thing you mentioned there as well was surprise sort of in the data. So would you say if there's like sort of negative data, which is quite surprising and maybe against the consensus, that would be a time to sort of open your eyes and watch out for potential lows?
Well, that's right. And I think the key thing as well is that's important is the importance of being prepared as an investor, is that, regularly, over the years, we see these dramatic events that can affect markets, or the markets themselves turn into sort of dramatic vehicles. And really, at that time, just to respond in a knee-jerk fashion to these bouts of volatility and so on isn't good. And that goes back to also the value for investors being somewhat prepared for these changes, because then it's like having a plan. If the market trend changes, what am I going to do? Well, it's probably a better idea to contemplate what you're going to do before it happens than trying to respond to it. Because when people are responding to things, sort of just in a purely reactive mode, they're more prone to act in purely a psychological fashion, emotional factor. Whereas if you can sit back, before these things happen and try and at least anticipate them, it allows you to perhaps make a more considered decisions when those events occur. And so, and that's why for some people that may not have the time or the inclination, it's much better to have a financial advisor than to do it themselves, because it is, being a productive investor, a successful investor, does it take a good deal of commitment and time to educate ourselves and to be aware of what is going on in terms of current events, and just developing the skills of investing, which are not always intuitive. In fact, most of them are counterintuitive in terms of being a good investor. So that's a decision as well that I encourage people to, there's certainly nothing wrong with having an investment advisor manage your money for you. I still encourage people to know enough to be able to ask good questions. But there's a saying I read from an old book on investing, and it was, and I always remembered it, and it was, if you don't know who you are, the stock market is an expensive place to find out. And I think that's just a great saying, and it's absolutely true. And so think about sort of, what you want to do, what your goals are, how much time and interest you have in investing, and then, proceed accordingly.
Yeah, definitely. I love that quote. I think that's. I was very lucky when I started. I didn't have much money, so I think because I think I would have lost a lot more. But
Well, that's a very good point, Anthony. That's another thing is for beginning investors or even professional investors. Usually, it's a good idea to trade smaller, and that's like an axiom. But it's a very good rule of thumb.
yeah, definitely. So for maybe let's say because a lot of our listeners are students, if they do have the time and they are interested in learning, especially in sort of global macroeconomics, where would they start? Would you say what's the best thing to do?
Well, I mean, there is a lot of free information available on the internet, and it can be a bit overwhelming at times, and it'll take a while for people to be to get familiar with it. One of the things about learning anything is that at the beginning, until you sort of have your own grounding in the discipline, it's very easy to be influenced by other people. When I started out in investing, I'd read a book, and in the early days, that book might, if it resonated with me, might have a lot of influence on me, and so on. As I got older and got more experience, and I had my own sort of experiences would be the best word for it. I had a different relationship with the information. It was easier for me to sort the relevant with the not relevant, and so on. So that's a process that young investors will have to go through. Is absorb, and I encourage them to, if they do have the interest, to absorb as much information as possible. But just be aware that your relationship with new information is likely to change over time as you get more experience, and so on. But for investors on a budget, there's a lot of free information available on the internet. For those that can afford to spend a bit of money for information, subscribing to a good, whether it's a global investment letter or something else, subscribing to a paid service can be valuable, because that paid service can help curate the information for you. Because if you're getting somebody sort of giving you once a month, sort of sifting through all of the a mountain of information and giving you sort of a qualified opinion and analysis, that can both be helpful in terms of interpreting the information, and it can also be a time saver. But I mean but the global investment layer is it is a paid service, and there is a subscription. So if people cannot or not inclined to subscribe to something, there is still a lot of information that is available on the internet. You just have to sort of start shoveling through the mountain of stuff, because some of the opinions and the data is just wrong out there. So I can tell you that for a fact. Some's very good, and some is just it can lead you down the wrong path.
Yeah, definitely. And I think what you said there is it takes time is definitely definitely true. It's like anything, it's compounds. The longer you do it, the more you know, and the more you know what to sort of listen to and what to ignore.
That's exactly right, and that's perhaps the most important thing. And to be aware. We all should be aware of what we try and be aware of what we don't know. But most people always sort of think the opposite. But I can attest just through my own experience that you know, the a humble approach is the best approach when you're talking about investing.
Yeah, it's definitely never a good idea to get too confident with the market.
No.
That's where we learn our lessons. So you obviously mentioned that you think there's potential for, sells in the future for US equities, and there's potential for bear market. What would you say as well? Is that the same for other developed markets and potentially other emerging markets, would you say?
Well,
Different?
yeah, the European markets are not as highly valued, highly priced as the US market. So on a valuation basis, there's less risk. However, the US market is by far the largest um, collection of equity markets in the world. So if we do see a significant pullback or change of trend in US equities, that's very likely to affect European stock markets as well. So even if you're not an investor in American stocks, it's important to monitor what's going on, in the United States in terms of the stock market and so on.
Perfect. Yeah, I think that's a great way to look at it. And while this isn't investment advice, obviously, because we can't give it, how would someone be able to sort of hedge against the down if it were to go down? How could someone sort of protect? I know you mentioned stop losses there, but is there any other sort of?
Well, stop losses is I would say the first one, just so you're preventing your stop. Something that I use is I go long volatility. There's an index called the S&P Volatility Index called the VIX, is what everyone calls it. That's the acronym for it. And so typically, when you see levels of market sentiment like we're having now that's very bullish, the level of volatility tends to become very low. And so the VIX index will go to low levels. And then typically what happens when you see a market correction is volatility moves sharply higher. And so my favorite for myself hedge strategy, or I'll also use it just as a long position if the volatility level goes very low, is to go long volatility. And that's a strategy that I've used for quite a while. And it's based on just the premise that volatility is endemic to life. If you look at any aspect of life, you see contractions of volatility, periods of quiet, and then periods where you've got a lot of volatility and all hell breaks loose. But sometimes, as with anything, sometimes you have to be patient with these trades. I am long volatility right now, but currently I'm underwater on the trade because I bought it earlier this year when volatility was low, but it's gone even lower. And so I basically have to exercise some patience here. I have no doubt that eventually volatility will spike up again, but I have no idea, when that would have occurred. I would have thought, it would have by now, but we're moving into, late summer and fall. And historically, that does tend to be a period where volatility can move higher. But that's a lesson as well, is that, even with a trade that I've used, reliably over the years, I'm going to have to, just be a bit patient with it. And right now, if I closed the position right now, I'd lost money on it. But I'm not concerned about it because I know eventually you're going to get the move in volatility. The thing is, I just don't know, I don't know with any precision when that's going to be.
Yeah, that's VIX has been quite interesting because what we've had, it sort of had 20 was sort of the resistance, and then now it's dropped down to 15 is sort of where it
That's right.
around. Yeah.
Now the 15 level is, coincidentally the level it was trading at just before the market break in 2020. So I'm not. I just throw that up there. Is that 15 is a low level? I thought 20 was a low level,
Yeah.
and 15 is even lower. So I guess the big lesson there is that just, to my mind, the big lesson from that is it just shows you how complacent investors are, and so that in itself, going back to my reliance on market sentiment and so on as a key ingredient into my process, is makes me on guard for a change of trend in the markets.
Yeah, definitely. I would say for anyone looking to invest in VIX, I think there's some fees involved as well every month, and there's some other things as well.
Oh, absolutely. I mean, absolutely. That would
Calculating.
be a strategy for more sophisticated investors and so on. I'm not, by any means advocating everyone else go out and buy VIX or whatever. But you did ask me sort of what my favorite my hedging strategy would be, and that typically is it. People can also buy put options too on shares and so on. But once again, options involve leverage, and leverage can, be wonderful when it's going for you, and then very unpleasant when it's going against you. So.
Yeah, Jeff, that was just the experience I learned where I longed VIX and I didn't realize there were the fees involved. So yeah, I thought I'd share that with others. So one thing that I've found that's quite interesting is you mentioned that passive investing can be quite dangerous, which I've sort of never really heard before. Can you expand on that a bit more?
Yeah. Well, passive investing, and that is basically buying index funds and ETFs that basically mimic either a market or some sort of a collection of securities and so on. Started out as a good idea, as in terms of it allowed people to participate in the equity markets and with reduced fees. And, the argument for them was that 80% of active money managers don't make the index, which is true. Luckily, in my career, I was part of the 20%. So, I do tend to be a bit more supportive of active strategies than many. So what turned into, though, what started out as a good idea has, I think, become, to my mind, a big potential problem, because passive investing has become so popular that over half the capital that's been allocated to equity markets is attached to passive investing strategies. And it's not just retail investors. It's, passive investing has been embraced by very large institutional investors as well. On the retail side, my concern is that the ease of passive investing has allowed a lot of people to basically ignore educating themselves about investing, and at least getting a rudimentary knowledge of markets, so that they're prepared if we have a bear market or a sharp correction or some kind of an exogenous factor like the pandemic last year on markets and so on. And so what my concern is on passive investing is that there's a whole group of people that are exposed to equity markets, but have not really cultivated a lot of knowledge about markets, so that if we do have a market pullback and they start seeing, significant drawdowns in the value of their positions and so on, they might be more prone to act emotionally in response to those developments, which itself might exacerbate the decline, because passive investing strategies have become such a large component in the marketplace. So that's where I see the potential danger, and that goes back to the notion of being passive kind of rubs me the wrong way, is that I don't think it's wise to be passive really in any aspect of life. I don't think we should be passive investors. I don't think we should be passive when we're looking after our health. I think that, I think that we should be interested enough that when we go to the doctor, we should be able to ask some intelligent questions about, what's this blood test mean, or what have you. And I think that that's true with relationships or anything. You have to. It's always better, in my mind, to be engaged, because the old saying is, the more you put into life, the more you get out. And I think that the passive approach is appealing because it's intellectually undemanding, but there's a cost to that intellectual comfort, and it's just, I guess, philosophically, I'm not disposed to sort of taking a passive view of things.
Yeah, I love that analogy. I think that's a really interesting way to look at things. And I think we saw what you said as well about sort of, these investors maybe getting out of the markets very quickly in 2020, because, the drop was just so quick compared to other crashes. And I think that's what we're sort of seeing, aren't we? That these crashes are potentially going to be quicker and quicker and quicker. So I think it was only a few weeks, wasn't it, compared to...
Well, the big reason for that, Anthony, was the response by central banks and governments, which was, has never, and not only in the United States but around the world, which has never been seen in history. I think that, I guess there's a couple of lessons. One is you got to pay. It's important to pay attention to what's going on in the world. I was lucky enough for the subscribers I learned of the coronavirus. I heard about it in January of last year being a problem in China, and I first started to write about it in February, and then I started to tell people that this could be a much larger problem for markets and not to mention human lives. And then in the March 4th issue, I basically said, look, this is not contained, and I advise people to basically go flat, sell equities. And that issue actually is available along with other issues as a free sample issue on the Global Investment Letter website. So people can read that. And I think the February issue is there and stuff. So I put some stuff up for free for people that want to read it. And anyway, so the lesson there is that you do have to pay attention to these variables that come out of left field. And the other thing as well is that you also have to develop a plan to respond to these dramatic drops in markets and weigh the risk reward of getting back in and so on. So once again, that sort of also, to my mind, addresses the importance of attempting to be prepared for markets. And even going back to the pandemic, I like right now, I would not be, trading the markets, purely based on what's going on with the coronavirus, but I still write about it every month because even though we have the Delta virus right now, which the vaccines seem to be pretty effective against, as long as you're vaccinated, but that's a whole other issue. But, what I'm concerned about is we have the Delta virus now. I think inevitably we're going to see an epsilon variant, that this virus has shown an ability to mutate. And so while the next variant, may be completely harmless, there's also the potential for it to also pose a problem. So, that is sort of part of my own thinking and why I tend to sort of adopt more of a widespread global macro approach in my investing, is that even though the worst of the current pandemic is over in terms of direct effects, until we're in a situation where this virus doesn't have the ability to mutate, it still poses a potential threat. Doesn't mean it's going to, but I am spending time every month talking to medical professionals about sort of what's going on with the variant and so on, and I talk about it. I'll some months it's just a couple of paragraphs, and other months, it's more. But that's an example of, you have to, if you want to be on top of things, you have to pay attention. And that's an example where, I hope people just, assume that, the worst is over, and the pandemic is going to recede in history. I certainly hope it does. There's the potential that it doesn't. So.
Yeah, well, I think COVID. Oh, sorry.
No, I'd say that's my 2 cents worth on the pandemic. I worry that, I worry about people that don't get vaccinated. I worry about people that let their guard down and think that the worst might be over, because, money is nice, but it's secondary to human lives. And so many lives have been lost with this pandemic that, I just don't want us to, fall prey to a false sense of confidence that we can let our guard down.
Yeah, I think that's so important. And as you said, I think COVID's been the best sort of example of why we should have a global macro viewpoint rather than just looking very, closely at the companies and being very secular.
Yeah, well, you know what? That's what I did, Anthony. When I started in the investment business in the 1980s, and that's what I did back then when I was a pure value investor, and that worked then because the environment was very benign. You really had next to no geopolitical risk. You had the Federal Reserve was just steadily lowering interest rates from the high level that it was at the beginning of the 80s. And so it was a very benign environment. But that has changed over the ensuing years. And as that changed, it's prompted me to develop and change my approach to what it is now, which I like to think is the proper response to the world that we're living in now.
Yeah, definitely. And I think that's the real way to look at it. Are there sort of any other sort of macro or geopolitical risks that you're watching as well that you can share with us?
Well, just going back, touching on, volatility, which is an ingredient into my thinking, is that, I make the observation, and I think I've published a chart on this, I'm sure I have, that the 1990s was an unusually low decade for market volatility. And volatility has a very strong tendency to be mean reverting, which means that periods of constricted volatility are ultimately followed by periods of very high volatility, so that we get back to historic norms. And so that suggests to me that the 2020s as a decade is likely to be very volatile for investors based on that. And that's just one input. And I caution people that, don't depend on any one measure for your decisions. But I also think that there are geopolitical factors at work that are likely to produce a good deal of volatility in the 2020s. Certainly, you have you've got a bit of a contest for global influence between the United States and China, which is likely to grow a bit more tense rather than ease as the decade goes on. In Europe, the European Union faces, economic and political strains that might, cause issues with, in Europe. I mean, we saw, Brexit has recently left the European Union. depending on what happens with economies and markets and so on, there's the potential going forward for other nations to leave the European Union. Italy is, there's a component, political faction in Italy that would like to see Italy leave the European Union, and Italy is a reasonable size economy, and so on, and that would certainly have consequences. So, I look at the European Union, which I think has been a wonderful idea, as it grew out of sort of what happened, in the two world wars and so on. But because Europe is such a heterogeneous continent, it's a real challenge to manage a whole host of competing interests and so on. And so, I look at the European Union and I say, there are challenges for the European Union. And will it look the same in 2029 as it does in 2021? Well, I don't know what's going to happen, but I'd be surprised if it looked exactly the same. And that process is going to create economic and political volatility.
Yeah, it's really interesting. So looking at it's what you're saying before, sort of the risk, and looking at, okay, what's the potential of this happening? Will it be the same? And just keeping your eye out on the potential.
And that's and that's it. Just being aware of it, because obviously you can't. I mean, I can't anyway. Form my positions on some vague expectation at 2029. But if I'm aware that these political potentials are out there, it'll allow me to respond to developments that I can keep my eye open on them. So what I try and do is invest, based on the evidence that I have before me. And so if we get too far out into the future, there isn't a sufficient amount of real hard evidence to justify taking a position. So I'm always trying to, weigh evidence, day to day or month to month, and as the weight of evidence changes, that's going to impact my investing positions and so on.
Yeah, it's interesting. So would you say, sort of when it starts to go in the direction that you think it will, you'll slowly put a position on, and then when more data comes to support that, you'll sort of increase that? Is that?
Well, it could be slowly, or it could be, quickly. It all depends. I try very hard not to be, doctrinaire. I try and be as pragmatic, I guess is the best word, as I can be. I've been fortunate in my career. I've run a number of number one funds and stuff, and that experience has produced a style that I practice now that I call pragmatic. It's, I just basically will use whatever works. And so in terms of investing, there are some positions that I've had, I will hold for years. There's other positions, if it turns out, if I think I'm wrong, I'll get out in a matter of days, and that's, particularly for all investors and younger investors, is that it's very important not to be stubborn and to be, to admit when you're wrong and to respond to it, quickly before a small loss becomes a larger one. And we're all guilty of that. I mean, I'm sure I've made every mistake that an investor can make over the years, but I like to think that I learned from them, and I make fewer of them now than I did.
Yeah, that's interesting. So you'd say just being adaptable depending on what you see.
Yes. Yeah.
Perfect. So Jonathan, thank you so much for being on the What the Finance podcast.
Thank you, Anthony.
Yeah, no problem. That's okay. Just in my final question, I know you've sort of given us some great information and some great lessons, but is there anything else that you would say are sort of some of the greatest lessons that you've learned while sort of as a money manager?
Yeah, well, I think Number one is read widely. Just read, and it doesn't necessarily have to be about finance. Read about history and geopolitics, and I guess another thing too is be aware of your own psychology as a human being. Because we're all as human beings, we're all fallible, and I certainly am. And just be aware that your psychology and your emotions will often lead you down the wrong path in investing. And trade. And number three is trade smaller. Especially and those that I mean, it's a very complex topic, but those three little nuggets, I think, probably are a good foundation.
Perfect, Jonathan. Yeah, thank you so much. So if anyone wanted to get in contact with you, I know you have your sort of newsletter as well. What would be the best way?
Yes. The Global Investment Letter website is globalinvestmentletter.com. And people can go on there. And if you click on the sample issues tab, I'll ask you for your name and email address, and you can get, I think there's 7 or 8 or maybe more sample issues that you can access for free. That will also put you on a mailing list for a weekly email that I send out that just talks about some weekly topic of investing, and people can unsubscribe to that email anytime, if they don't care for it. So that would probably be the best way to reach me.
All right, perfect. Yeah, thank you so much for joining the podcast.
Thank you very much, Anthony.